If you want to become a millionaire fast, then you need to understand this real estate investment strategy. Hey, what's up guys? It's your boy Matty A back on the channel, bringing you another killer wealth building video. And I probably reeled you in a little bit on the hook with Millionaire and Fast. But if you guys follow me in the channel, you know that I'm a big believer that the best things, especially when it comes to wealth, are made in the crock pot and not the microwave, and they take time. But that being said, if there were one investment strategy I could say would make you a millionaire faster than any other out there, that is value add real estate investing. And today I'm going to show you how I made over $1 million on one of my boutique hotels using this specific strategy in just 12 short months. And whether you have, any experience at all with commercial real estate or not, I'm going to show you how simple this is and why some of the world's wealthiest people use this strategy to increase their net worth and their income in very short periods of time. But before we jump in, you know what time it is. Make sure you subscribe to the YouTube channel, smash that like button so the YouTube gods share this with more amazing people like yourself. And if you have any questions for me at all, feel free to drop those down below, and don't forget to check out all the links and resources down there as well. So what do real estate investors like Donald Trump, Sam Zell, Manny Koshman, Jeff Sutton all have in common? Well, yes, these are extremely wealthy and successful individuals, but that's not the answer that I'm looking for. What all these investors have in common is that they've all mastered value add real estate investing. Now, if you don't know what that is, value add real estate investing is a strategy where an investor purchases a property that is underperforming or has the potential for improvement. And the investor goes in there with a specific plan, which we're going to dig into what those kinds of plans are today. And they add value to it through renovations or upgrades or operational enhancements. And really simply put, at the core of this strategy, the goal is to increase the property's income, which as a result increases the property's value. And then they want to sell it for a profit and rinse and repeat. And while you may not feel like you're anywhere near these big name investors, I figured I would show you a very simple example on how I did this with one of my investment properties and made over $1 million in just 1 year, and how you can use this exact same strategy for yourself too. And I'm telling you, if you want to be a millionaire, this is one of the fastest and most sustainable ways of doing it. All you have to do is find a property that is undervalued or underutilized or run down or mismanaged, ideally all of the above, but at least one of those, purchase it at a discount, and then identify and invest in the necessary upgrades and improvements and operational efficiencies that will result in an increase in the property's income, which in turn will massively increase the value of the property itself. And I'm telling you, you can't make this kind of money with this little investment of time and energy and really any other investment class, at least not that I have found. So if you master this strategy, you can easily become a millionaire. Now, as many of you know, and if you don't, I've been a real estate investor now for going on 12 years. And in my early years, I spent a lot of time flipping houses and buying single family rentals. But it wasn't until I transitioned to commercial real estate and began focusing on value add opportunities like hotels and strip centers and medical plazas that I own that things started to get a lot sexier from a financial perspective. And to share a little secret with you, commercial real estate is actually much simpler than single family real estate with a far greater upside tied to it. And one of the first experiences I had that taught me this valuable lesson was on my very first boutique hotel. In 2019, I had someone call me and present an off-market opportunity on a little hotel in Lake Tahoe in a great area of town, but it was very run down physically, it was poorly managed, and it was financially underperforming. And after I toured it and dug in on my analysis, I predicted that if I renovated and rebranded the property and made it cool again, where people wanted to come stay, I increased the occupancy, where the property looked nice and it was clean and it was safe, that people were going to want to come stay at it. And if I built up a new management team and ran things a little bit more efficiently, I thought, hey, I think with this plan, I can drive more revenue and increase the income. I could drop some of the operating expenses of the hotel, and ultimately, I could create more of what we like to call net operating income. Now, real fast, when it comes to commercial real estate and value add investing, there's really two main things that you need to understand: net operating income and cap rates. For those of you who don't know what these are and why they're so important, let me explain real fast before we continue. Net operating income, or NOI, is a measure of the income generated by a property after deducting all the operating expenses. It's as simple as subtracting all of the property taxes, insurance, maintenance, management fees, if you've got a staff or employees, payroll, things like that, from the total income that's generated by the property. Basically, in value-add real estate investing, NOI is the most important metric to focus on because it is used to determine the value of the property. So anytime you can increase the NOI of a property, you know you're increasing the value of the property. Now, a capitalization rate, or a cap rate for short, is a metric used to determine the value of a real estate investment based on the property's net operating income, and cap rates vary depending on the property type or location or market conditions. Generally, properties with higher risk or that are less streamlined or stabilized, like the lodge that I was buying in the condition that I was buying it in, those are going to have higher cap rates. And properties that are lower risk or that are much more stabilized and have more predictable income, those are going to have lower cap rates. So back to my example, when I bought this underperforming lodge, I bought it at a higher cap rate and a lower price because the net operating income was low. The condition of the property was poor, and it was seen as a riskier investment due to all the work that was needed to be done to stabilize that property and that income stream. But that's exactly what value-add investors like myself look for, right? We don't mind the hard work. We like the diamonds in the rough because we know that's where all the value is at. We know that we can go in and, improve the property, its physical condition, increase the net operating income, streamline the operations, stabilize things, and therefore I can lower the cap rate tied to the property because it becomes less risky, and therefore that will increase the overall value of the asset. Now, let me show you a little bit more about what I mean by this. When I bought this property, it was a rundown property and what we would call an unstabilized asset. It was showing about $85,000 a year in net operating income, and I bought it at an 8.5 cap. So when we run the numbers and take the $85,000 in net operating income and divide it by an 8.5 cap, that gives us a value of $1 million, which is actually what I ended up purchasing this property for. Now, here's how I made the $1 million in the following 12 months. After closing on the property, I renovated it, I rebranded it, I added in some property technology that allowed us to automate a lot of the experience and operations that was really being done very poorly and inefficiently before, which ended up lowering our operational costs. And with some new marketing, getting it on Airbnb and other travel agency websites that it wasn't being marketed on before, I was able to drastically increase the annual revenue, lowering many of the operational expenses in the process. And 12 months later, the property's net operating income had grown to $165,000, which was $80,000 more than the previous year. So you're probably still wondering, okay, well, how does that translate into $1 million? Well, remember what we discussed earlier on in the video. When it comes to commercial real estate, the value is determined by taking the net operating income and dividing it by the going cap rate of that asset class. And in this scenario, I increased the net operating income from $85,000 to $165,000. Now, the difference there, that's $80,000 more than it had the previous year. And when you divide that amount, that $80,000 by the going cap rate for small hotels in Lake Tahoe, which was about a 7 cap, that's $1.142 million in value. So just by increasing the net operating income by another $80,000, I was able to add over $1 million in value to my hotel, which I don't know about you, but I don't know many other ways that are out there that you can actually increase your income by only $80,000 a year, but grow your net worth or your balance sheet by an additional $1 million as a result. This is why so many real estate millionaires and billionaires use this exact investment strategy to increase their net worth and their cash flow. So to recap, if you can identify an underperforming commercial asset, it doesn't have to be hotels. I've done this on my commercial strip centers, medical plazas, other investment properties. I've seen people do it on RV parks, mobile home parks, storage facilities, apartment buildings, basically any commercial real estate asset that trades on a cap rate. If you can find a commercial property that you can increase the top line revenue and lower the operating expenses, and you can expand the overall net operating income. You can literally go and force value of hundreds of thousands of dollars, if not millions of dollars worth of value into these properties and reap all of the same benefits of value add investing for yourself, just like the big boys and the big girls do. That's it. I hope this video was helpful for you to wrap your head around the simplicity of what value add commercial real estate investing looks like and how many successful people have built massive wealth by doing something as simple as this, and how you can really go out and do this yourself. So if you enjoyed it, don't forget to smash that like button. Be sure to subscribe to the channel. And I just want to say thanks for rocking with me until the end. If you know somebody that could get some value from this, tag them, share this video with them, and don't forget to check out all of the links and resources down below. Until next video, cheers, my friends.